Today we're going to talk about forward-looking finance, the time value of money. And what we mean by the time value of money is that a dollar today is worth more than a dollar in the future. And the relationship between the two, between present value and future value, is the discount rate or an interest rate. For example, if you had a dollar today and say you could put it into the bank and collect 10% interest on it, well, what would that be worth in a year? Well, it's going to be worth $1.10, right? It'll be worth, you'll still have the same dollar, but you also have 10 cents of interest that you collected for that time. So if you can take a dollar today and make it be worth $1.10 in a year, then if you were offered the opportunity to get a dollar a year from now, you'd have to discount that to see what it would be worth in today's dollars, right? So you'd have to say, well, if I could take a dollar today and make it worth $1.10 in a year, what would a dollar a year from now be worth to me today? And without doing the calculation, somewhere, in the 92 cents. And what it would mean was if you took that 92 cents and put that in the bank today at 10% interest, a year from now it would be worth $1. So that's the relationship basically between present value and future value. And that's what we're going to talk about. It's basically the old adage, a bird in the hand is worth two in the bush. The two in the bush represents the unknowns, the uncertainty of what you're going to get in the future. And that has to do with the risk. And a lot of times what we do, we price that risk, and that's part of the interest rate or the discount rate as well. So we have a couple of segments here, and let's get into the first one on the time value of money so that we can get that concept pretty solid in our heads. Then I'll come back, talk to you to some more, and then we'll go into another concept, discounting cash flows. And that's basically taking that concept of the time value of money and applying it to cash flows coming into the future. And this technique is how bonds are priced, how stocks are priced. We're looking at what are the revenues, the anticipated revenues in the future, and pulling them all back to today's dollars and saying that's the present value of that stream of cash flows. So the time value of money is the technique also for valuing projects. For example, say we were thinking about building a new power plant. We were an electric company, a utility company. And say it was going to be a nuclear power plant and it was going to cost $1 billion to build. Well, we would look at what are the anticipated revenues for the next umpteen years from that power plant, pull all those anticipated revenues back to the present, and see what that present value sum of all those future cash flow streams would be. So say if it came out to be $1.5 billion, then we would think, okay, this project is worth doing, right? We spend $1 billion today, and we anticipate getting the present value over time of $1.5 billion. So it's net good as a project to the tune of $500 million in this case. That concept is called net present value. And in the next episode, that's what we're going to get into is actually net present value. Once we get these concepts of the time value of money and discounting cash flows, once we get those solid, then we'll go and look at the net present value. And that's really the gold standard of valuing any type of income-producing assets, companies, bonds, projects. It's really the gold standard. That is the key tool of finance. So I just want to give you an idea of where we're going with this and what you can anticipate. So let's get down to it now. Let's look at the time value of money, and then I'll catch up with you on the other side of this, talk to you a little bit more, and then we'll go into discounting cash flows. Catch you on the other side.